Well, thank you very much for joining us here today. You have quite a record in calling bubbles and things that went wrong, whether it's 2000 or what happened in housing later on. And now you've come out with a new book, I'm surprised you're still alive, called Finance and the Good Society, in which you make the case for all of the things that may have gone wrong in finance, the financial industry. It performs a vital and essential service, and we better not lose sight of it. So given what's happened with the stock market in the last 12, 15 years going nowhere, and all of this anti-finance industry stuff we hear today from Wall Street occupiers and politicians and everyone else, looks like finance hasn't been in such disrepute since the 1930s, or perhaps since the early 1700s when you had stocks banned in France, Mississippi bubble and the like. So why the book? And tell us, what's good about finance?
Well, I think that there's always been people saying that financial institutions are important for our modern society, but people are starting to think that it isn't true. They're starting to think that it's self-interested. But I think there is a lot of truth to it, and it's fundamental that our society is built around financial institutions. Things that we want to see happen have to be financed, and that's the way it works. And the financial system allows activities to happen, things that will happen not just momentarily, but that will go on for years and years, and it allows our purposes to be fulfilled. That doesn't say that bad things don't happen in the financial world, but the basic core is an invention of incredible power.
And in essence, stripping away all of the complicated instruments and the like, finance is essentially a middleman, taking resources from those who may have excess resources or want to park it somewhere and putting it in the hands of those who want to put it to work.
Yes, we're saying things that, I'm trying to put a new color on these. These things have been said. Adam Smith said that sort of thing. But yes, it's true. And you know, sometimes it creates bad feelings, you know, I mean, but it produced the prosperity that we have today. And the world is emerging into, the emerging world around everywhere is developing rapidly, and I think it's because of the growth of financial capitalism.
Let me just give you a noted Volcker quote from Paul Volcker, and you can respond to it. He says, "I wish someone would give me a shred of evidence that financial innovation has led to growth." He's talking about the last quarter of a century, other than ATMs. He grants that may have
That's
some
right.
uses. And we get these stories, Greg Smith, oh, the perfidy of Goldman Sachs, as if it was widows and orphans who were Goldman Sachs clients and the like. How do you respond to that? What do you say, all right, here's where financial innovation has done a lot of good, you just don't realize it?
Well, I think you have to start looking at the mechanism. I don't know what people want as proof that financial innovation has helped economic growth. How would you prove that? We've had, you know, we could do a controlled experiment that would cut off some country from finance completely, and I bet they would go down the tubes as a result.
Greece may find out.
Yeah, but we can't do that. And so it's one of those things that is hard to prove, but I think we can make a pretty solid case for it.
Well, you cite some very basic things, fire insurance, the mortgage where you pay down a little bit instead of the old one where you, every 5 years you hope you get a renewal, and now you had self-amortizing mortgages. Other quick examples come to mind that people take for granted but don't realize came out of finance?
Well, I like to give, you know, Paul Volcker said that the only innovation he could think of that he liked was the ATM machine. That was just 2 years ago when he said that. So I like to give examples of innovation that's happened since he said that. Well, and one of them, it's kind of interesting, is the new crowdfunding that the U.S. Congress created with the Jobs Act. This will allow something like the Wikipedia phenomenon to be extended to actual investing. So it's adapting the internet technology to kind of bring more people into venture capital. It's an experiment. It may not work, but I think it's an interesting experiment, and it illustrates one of the principles I talk about in the book, which is the democratization of finance. Over the centuries, by democratization I mean bringing more and more people in. Over the centuries, financial institutions which were very small and rare have become a bigger and bigger part of everyone's lives. And I think this is the kind of progress that innovation can make happen and that we want to see continue to happen.
Well, two other examples way before ATMs, but very relevant: mutual funds.
Right.
Put in a handful of dollars and get shares. Or money funds, breaking down old depression price controls and interest rates. Now you too could get a market interest rate when we had market interest rates.
Yeah, I think, well, I've written a book with lots of examples. One that comes particularly to mind to me is the invention of stock markets. That is a very important invention because what it does is it allows people to take part in a business enterprise to whatever extent they want, however many shares you want. And it allows you to reward people by offering them shares in an enterprise, and you can scale it up or down as much as you want. And then there's a price which is observed every day. Not always rational. The price can be crazy sometimes, but the mere presence of this institution, I think, has been a huge driver for economic growth.
I don't know the exact numbers, but if you compare price-earnings ratios of a firm that would have been sold 150 years ago or even 120 years ago, compared to what you'd get precisely because you have a stock market and open price information, is almost exponential, 2 to 3 times what you would have had in the old days.
Well, since the stock markets were created, we have seen enormous returns on stock, on average, over time. So something they're doing right, and I'm not sure how to explain that.
Let's quickly hit, and then we'll discuss the crisis itself. Some of the things they throw against markets. Derivatives. What do you say about derivatives?
Well, derivatives are exposures to risks that are well defined, allowing people to hedge the risk that you might be too exposed. Like I've advocated a derivative market for home prices, so that we actually created one at the Chicago Mercantile Exchange. Homeowners can now, if they feel that they're overexposed to real estate risk, they can hedge that by shorting the real estate market. And if they're underexposed, suppose you haven't bought a
Goldman
house.
Sachs doesn't have to invent an instrument for a Paulson anymore for you to...
Yes, now, that's right. So Paulson managed to short the housing market only indirectly. But now, well, he had to do that. We had our market in place, but I think it was too small for him. But as these things grow, people will be able to take positions. Now, some of them will make billions for doing that. But I think that's what happens when you create a game that's not a game, it's the game of life, for everyone. And I think it's on balance a good thing, very much a good thing for our society.
Millisecond trading, flash crash. You have an interesting thing to say about that nefarious instrument called the telegraph.
That's right. Well, modern information technology is really changing the world, and it's speeding things up. It's created some people who necessarily specialize in what we call millisecond trading, which is using computers to trade. And they can get ahead of you in line because they have a computer which is faster than you'll ever be. So there's some concern about that. But I don't think that there's anything damaging. Now, there may be some reason to regulate them, but I don't see it at the moment. And I note that on your Forbes 400 list, I don't think, tell me if I'm wrong, there isn't any millisecond trader on the list who made it through millisecond trading. So I don't view them as important. I think it's kind of a good story. It's a little bit like, now we have computers, and so we do things with computers, and so some things happen really fast now. That's all it is. I don't think it's something to worry about.
Just the speed is more. Like telegraph, suddenly instead of laboriously sending pigeons, you had it in an instant.
Yeah, it's neither really amazingly good or amazingly bad. It's just an implication of information technology. And I think we're going to see a lot more implications develop as time goes on. I mentioned crowdfunding as another innovation. As information technology is expanded, it's breathtaking, I think, to think about what will happen in our children's lifetime as information technology expands along with the application of financial theory.
And you touched on it just barely, front running. What do you say to people? Well, that means they're going to get a better price than I'm going to get.
Well, front running is, I think, unethical behavior that brokers implicitly promise not to do. When you tell your broker, I'm going to buy a large number of shares of some stock, and he's operating as a broker and not a dealer, he should stay in that capacity and not buy on his own account ahead of you and take some of the money from you. So that is a matter of ethics. Now, I suppose your broker could tell you, I'm not trustworthy. You tell me anything and I'll use it for myself. As long as he discloses that, and if you want still to deal with him, then I suppose there's nothing unethical. But business ethics are a central part of the functioning of financial capitalism, and people have to live up to what they've told you they will do. And front running doesn't fit that mold right now.
You've mentioned the book that in terms of finance being in ill repute, it's sort of always had an odor for several thousand years. But it seems that it really comes into sharp focus when there's been a financial crisis. Why did we have this financial crisis? Was it some inherent flaw in free markets, or were there other factors at work that just nearly ran the system off the rails?
I wouldn't call it an inherent flaw in free markets. I would say it's a flaw in the systems that we had in place and institutions. We've had, in history, had to reinvent our markets and our financial institutions. It's not just the government, it's the private sector and the government that have to change their thinking in response to accidents. This was an accident. It happened because of some misunderstandings about, there were bubbles that grew and burst, and those things happen, which, in my book though, I say bubbles are not inherently a financial market phenomenon. They occur even when there are no financial markets. So I give in my example of speculative bubbles the great leap forward that Chairman Mao created. If there had been an ability to short the great leap forward, and if there had been analysts publishing their interpretations of Chairman Mao's prescriptions, that would have lessened the impact of that bubble on Chinese society. So the idea of financial markets is, yes, people are faddish. They can go off on a tangent for a long time. But the best way to deal with that is to have a free access to markets and to have somebody who can freely analyze the prices that are developing in the markets and then take hedging steps to prevent a disaster. So the fundamental problem isn't free markets. The fundamental problem is the existing institutions and the existing models that people had that have to be fixed and improved. And that's progress. We'll do that.
What do you think were the models that went wrong?
Well, one thing that, I could go on at great length about this, but what comes to my mind first is that we had a efficient markets theory that was thought to be a reason to trust market prices in excess. People thought that markets can never be wrong, that you can't beat the market, just swim with the tide because the market is smarter than anyone. I know you don't believe this, having read Forbes magazine. I know that it pays to think about what's going on. And another thing that developed was kind of excessive respect for mathematical, statistical models. That we thought we had experts who had programmed everything and figured out everything. And we had value at risk and other methods of analyzing. But ultimately, those methods are only as good as the people who use them. And we kind of forgot about people. We should never forget that it's always people who are behind the institutions.
Doesn't that argue a little bit against financial instruments? Where you say here, in effect, that we had hubris in managing risk. Manage risk, therefore no risk, therefore I can go leverage up 100 to 1 because I've precisely done it in a way where I've minimized the risk.
Well, hubris is a human failing that is concerning. That I don't know what to do about it, though. One thought is that one thought, which Louis Brandeis said, the Supreme Court Justice, sunshine is the best disinfectant. So as long as we require people to disclose what they're doing and be honest about what they're doing, as long as we have analysts who are doing their job in an honest way and are not, in cahoots with somebody, these things get revealed, and the hubris that some people show is exposed. And that's what a democratic system and financial capitalism properly designed can achieve.
Now, what role, and I know this is not taught in schools anymore, but could we have had this disaster if the Fed hadn't cheapened the dollar so much? After all, in the 70s, we had a commodity boom, we had a housing boom.
Oh,
and,
yes, right.
And so if they had done their job, could this thing have reached the size that it did if they and the other central banks weren't pumping out excess money?
Right. Well, that was definitely a factor. The interest rates hit zero practically while the housing boom was going on in the early 2000s. So I don't know how to estimate exactly how important that factor was, but when you have really big historic events, it's probably a combination of factors, and that was one of them.
In terms of fixing the housing market, you've talked about pre-planned workouts where if something goes wrong in the mortgage, it automatically goes down. What are your thoughts about going back to once made mortgages what they once were? Prime credits, because you put 20% down with a 20-year payout. You couldn't get more than 4 or 5 times your income, and they worked.
Right. It's kind of remarkable historically that it used to be, if you go back before the Great Depression, it was even more than 20%. I think they would often ask for 50% down to buy a house. And so somehow the loan-to-value ratio just crept up and up. And it was part of a complacency that developed over all these years. But then now the question is there some systemic problem that led to that? One of those problems that may have encouraged it is that we created government institutions, Fannie Mae and Freddie Mac and FHA, that gave implicit government support to these mortgages that might have previously been considered too risky to issue. And that's part of the problem. It's also partly just the complacency that we got. This is independent of the government, from having no repeat of the Great Depression for the better part of a century.
Do you think FHA is still on pop bubble? The way they've been?
FHA worries me. The FHA, it claims that it's okay.
Where have I seen that movie before?
But I've seen, Joseph Jorko at the Wharton School has a paper pointing out that, or arguing that the FHA is in a vulnerable position. Having seen the housing market decline so much and having so many underwater mortgages. So I'm inclined to worry about the FHA. And right now, a lot of people are hoping that everything will be fine because home prices have started moving up again. And they could just get off scot-free if they just have a huge rally in the housing market. That might happen, so FHA might be just fine. But I tend to be worrisome, and I tend to think that it may be much longer in coming, this rally in the housing market, and it won't be enough to bail them out.
Would it have been better for the government once the disaster hit to let, as they used to say, let the markets clear? And people say, my gosh, I've never seen prices like this, never see them again, better get in. You saw a little bit of that in Phoenix and Las Vegas before the fall of 2008. People are starting to nibble again.
Yeah. Phoenix is what's going up right now rapidly. And markets are inscrutable. I don't understand what happens and why these booms happen or where they are. As for letting the chips fall where they may, I'm just not, I don't have the nerve to do that. If I were Fed chairman, I would have done something like Bernanke, because I don't know what...
Not so much in the panic of September when the system almost did get cardiac arrest. But in all the government programs since then trying to help housing and end up not doing very much good for housing.
Well, I tend to be sympathetic to people who got caught in this mess and they're unemployed and they're losing their house. Now, my idea is that we should do something for them, something constructive, but let's make it happen so that the government doesn't need to get involved the next time. So we should rethink our mortgage institutions. And I've argued that for pre-planned workouts, that would be not paid for by the government, that would be priced into the original mortgages so that people don't, they don't have to have this problem again. And that, to me, that's the epitome of financial capitalism. You see a crisis like this and you say, how can we as private citizens work around so that this doesn't happen? We don't want it to happen again. My proposal for pre-planned workouts doesn't even require the government. It probably will involve the government as facilitator, but it doesn't necessarily have to be that way.
Well, this gets to Dodd-Frank, which you pointed out previously. Whenever one thinks of the need for reform, this has got, what, 50 studies, Lord knows how many new bureaucracies.
Yeah.
Is this going to hurt innovation? I mean, one bank head told me he had to hire 1,000 extra people for compliance. How does that help innovation?
Well, we have to get the right balance of, we don't want, you know, I've tried to innovate. I know exactly what he's talking. I had a company, I still have it, that tried financial innovation, and we had to go through regulatory approval, and it slowed us down. On the other hand, I think regulators are important, that if we didn't have them, we would have fraud and corruption and abusive things.
But there's a difference between rules of the road that say don't go above 60 or 70 or whatever, and telling you what car to drive. And it's not either crushing regulation or anarchy. It ought to be something where you can innovate. And
Well, I agree. I agree with you that we need financial innovation. My impression is that I actually have a favorable impression. I mean, you probably have a different impression of regulators than I do. That I think that they're well-meaning people who are trying to make the system work. They're limited often by bureaucratic structures. It's government, right? And you can't just give free rein to your imagination. But I think I'm probably warmer to regulators than you are.
Well, not to belabor the point, but you've made the point in terms of history that you have to update the rules of the road. For example, when they try to take over the Erie Railroad, that great fight after the Civil War, and Gould would issue stock at midnight. No, you cannot do that anymore. Sensible rules of the road still allow for plenty of innovation.
Well, Dodd-Frank is an awfully long bill, and it does raise concerns. But I'm actually sympathetic to that bill because it did try to confront the house of cards collapse that we saw. And it wants to prevent, the preamble to Dodd-Frank says, let's prevent taxpayer bailouts. It's the too big to fail problem that we want to deal with. And as long as we think some companies have to be bailed out to save the economy, we'd better prevent that from happening again. So I thought the Dodd-Frank bill was a nice try. We'll see how it works in practice. It's too soon to tell. But it's a complex system, and that bill is complex. And I'm sure many parts of it will have to be changed later.
You've talked about the need for financial advice for everyone. Do you foresee the possibility of, in terms of financial advice, a variation of A.P. Giannini, who founded what became Bank of America, serving communities, i.e. in those days immigrants and merchant seamen that traditional banks wouldn't touch? Do you see ferments of innovation of people figuring out how do you get these unserved markets and doing in effect what Giannini did and create a new kind of institution in traditional industry?
Well, it is happening. I don't know exactly all the things that have been happening, but for example, there are some private organizations that are dealing now with mortgage advice. It isn't just the Dodd-Frank Act created an Office of Mortgage Counseling, but that's small. I think there's lots of things going on of people who are changing the way the mortgage industry is happening. There are also lots of financial advisors. I think it's changing all the time. There are these fee-only advisors who express commitment to their clients. I think that movement has been growing. We see a lot of little innovations in financial services that I do think are bringing us better toward good financial advice, more readily available.
Quickly, your index versus the median prices we hear in housing. What's the advantage of your index in terms of getting a real understanding of what's happening in what still is a very fragmented market?
Well, a repeat sale index infers home price changes from changes in prices of individual homes, and it deals with a problem that plagued the median, namely that sometimes people put a lot of big houses on the market, and it pushes up the price temporarily. If you look at the simple median, uncorrected, of home prices, it tends to be noisy and jump around. So my colleague Carl Case and I first published an ongoing, we were the first to create an ongoing repeat sale price index. And people were stunned to see how it looks. It's not as noisy or choppy as you might have thought by looking at medians. It's a more stable and trendy series than had ever been realized. I think we got to a better understanding of these markets.
And finally, stocks. You certainly called a couple of big markets, but tell us the story about arguing with your spouse and not getting too caught up in trying to time the market.
Okay. Well, I'm not sure which story you're asking about, but in 1996, I testified before the Federal Reserve Board with Alan Greenspan, and I was trying to urge on Greenspan and the board that the market was going through a bubble. In 1996, this was well before the peak in the market. And he gave a speech called Irrational, where he used the term irrational exuberance in it. And the markets all over the world dropped on his words. And so this is where I got into, I told my wife, I don't know what story you're asking. On the morning after his speech, I told my wife, I might have caused a worldwide stock market crash because I talked to Greenspan, and then Greenspan gave a speech, and then I told Greenspan I thought the market was overpriced. Greenspan gave a speech, and then immediately the world stock markets dropped. So my wife told me, "You're crazy, Bob. You couldn't have done that." But then when she saw how much talk and consternation followed his speech, she said, "Well, possibly you're right. She put that in our Christmas letter that we mailed out with our Christmas cards. Bob caused an international stock market crash. I don't think I did. I don't think, we know that Greenspan did though, because the markets are vulnerable. When someone says something, they move. Something as frivolous as the words irrational exuberance. And that brings me back to one of the themes of this book. The crazy things that sometimes happen in financial markets lead some people to doubt the value of the whole concept of the financial sector. But the theme of my book is that crazy things happen with people, and the financial markets reveal, they tell you the ugly truth. You see the price movements. Everybody knows what happened and how big it was. And then we learn from this experience. And then we have experts who have seen and know these data. So the next time around, we're not as crazy. So I think that the financial markets and all the professional organizations and all the experts and the people are dealing with difficult problems, and they're dealing with them in a much more sensible way than we would have with any other economic institution.
So getting mad at finance is like shooting the messenger.
That's right. That's a very nice way of putting it.
Bob, thank you very much. The book is Finance and the Good Society.